Hi everyone, my name is Piterpakulski. Today we have a final overview of a real estate acquisition financial model. I will walk you through the model. I will be showing you what inputs may affect financial efficiency of this business idea. So if you find this video valuable, you may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. And in the description of this video I will be giving all the links on the whole process how I created this financial model from scratch. And also at the end screen I will be sharing the link to the playlist where all the videos how I created this model will be placed as well, so you can watch video by video and see how all these stuff appears from scratch. So the first rule that we have in all our models is we have a specific color for all the inputs. So this is needed to you will be playing with scenarios 100%. You will be sending this financial model to third parties, your business partners, your investors, or your friends, and they need to find the inputs easily, because if they won't be able to find it, they will be hard to play with scenarios. They can spoil formulas and so on. So to avoid different mistakes, just assign some specific color to all inputs and you will be good. So first of all, we start with specifying the first year of financial projections. Then we specify the house price or an apartment price that we are going to buy. So this will be the price, asking price to buy. Then we specify the percentage of down payment. Then we specify the term of loan in months, the mortgage, interest rate of this mortgage. If we do have any grace period for principal payments or interest payments, we can specify this grace period in months here in these two cells. Here we specify the rent. This will be our revenue. Then we set up when the deal starts, so when we buy this house or an apartment, year and month. This is done like this. Then if we plan to sell this house or an apartment somewhere in the future, we can specify the moment in future when we're going to sell it, and if we are not going to sell it, we can just select this year. It is not inside the financial period in our financial horizon, and the house won't be sold or an apartment will be sold. So this is the moment of when deal happens. This is the moment when we sell the house or an apartment. If we do, then if we sell, we are specifying the selling price of our real estate, and then we're moving to the revenues. First of all, we need to specify the time to the first deal, because during this time we will be already paying the mortgage and we may have some other costs, but we won't have the revenues. So this will produce some operating losses, like for example, for these 4 months, if we go to the cash flow statement, we have these 4 months of operating losses, and we need to pay the financing needed to this for this business idea will be calculated from investment stage expenses plus operating losses during these 4 months till we find the first tenant. Then we specify what will be the leasing term, the contract, how many months the tenant will be paying us. Then we assume that after this contract, after the end of this contract, the tenant will drop, and we will need, for example, 2 months to find a new tenant. and during these 2 months we won't be having revenues, so that's why we need to add this parameter to the inputs. Then we say that, for example, we will be inflating the rent, so the inflation rate for the first year will be 0. Then we can specify how the rent price will grow. This is the percentage to the previous year. Then we assume that we do have some operating costs. They may even have some seasonality. Some of them will appear in summer, some of them will appear in winter, some of them, for example, may appear only once in a year. And then we also specify when operating costs appears. So after we buy a house, since that moment when these costs appear. So this will help us to calculate more accurately the operating losses and totally we can calculate the right way the amount of financing that we need to start the business. Because if we do have these expenses starting earlier, before the revenue, we will be able to see how much extra financing we will need to finance these operating costs. Then we inflate different operating cost items. So this is the list of operating costs. Here they are, and here we inflate these operating costs because they may grow with different speed, and this will affect financial efficiency, profitability, profit, the level of profit, and so on. Then we specify initial acquisition costs, everything but purchasing. So we may have some extra investment costs during the investment stage. This is not the price that we're paying to when we buy the house or an apartment, but we may also have some advertising costs. We may also have some transport costs or so on. So different, for example, lawyers and so on. So we may be paying some money to some companies that provide some real estate services to find the best deal and so on. So we can also include these expenses here. So this is the deal. These are 4 months before the deal, and here we specify what expenses happen before the deal. Then we specify the level of taxes. So this is the asset tax monthly, this is the revenue tax as a percentage of the revenue, this is the profit tax, the percentage of the profit. And then we move to the cash flow statement. So cash flow statement is the main statement where everything is shown. If you want to get acquainted with your business idea, you will be 100% looking at your cash flow statement. So these are the revenues consisting of rent plus revenue from selling the real estate properties somewhere in the future, for example here. Then we have operating costs, taxes. Then we calculate the operating profit, the result from operating activity. Then we specify total of investment, result from investment activity. Here we calculate the amount of down payment needed. Then we calculate equity needed. Then we pull the amount of loan given to us from the bank, mortgage. Here we can see the interest payments, principal payments, and here at the cash balance at the end of the period we can see the breadth of the project. So here is when the project is our cash or bank cash, and then since this moment the project starts generating its own cash balance, and we can look at the time and see how much cash is generated by this moment in somewhere in the future by the project. So this is cumulative parameter, and we can see, so by, for example, October 2025, the business generated $471,215 of cash cumulatively. And then we can see how much financing is needed. So this is the down payment, this is equity that we need to finance operating losses, this is mortgage, this is total financing. Here we can specify what type of payback period we would like to look at. So this is the payback period of the total financing of only your, for example, financing of this project, but we can, for example, switch to all financing needed. This will be another numbers, and you can switch between these two types of simple and discounted payback period diagrams. Here they are. Then we get main financial parameters, and here is a very simple table where you can see the revenues totals, expenses totals, monthly profit, and monthly profitability of your business idea. Then here we can see simple and discounted payback period of your scenario that you've created. Here you can specify the level of discount rate. Here you specify the step of changing the discount rate to calculate the internal rate of return more accurately. This is the starting percentage of discount rate that you would like to start with. If we look here, so for example, 46% rate will be the internal rate of return of our business idea. And then all these numbers go here to sensitivity analysis. So here we have here we can specify, for example, the step of changing, the step of adjusting this parameter. This is the basic value, the current value of this parameter, and then we decrease this parameter and increase this parameter, and we can look at the financials of our business idea if the parameter is growing or the coefficient is growing or decreasing. So for example, we can add this parameter, so we can go up just for a second, just for an example. So we can go to rent, we can press equals and add here and multiply this value to this sensitivity analysis parameter. Then we press enter, and we can go back, and now we can press sense and see how our project is flexible towards increasing or decreasing the rent. So let us do it. Then we, for example, would like to see, so we can delete this parameter from rent and add this parameter to the selling price of our house. Now we can go back, press sense button again, and see what will happen with our financials. So we can also increase, for example, the step of changing. So we can see here new values. So now I think I showed you the main parameters that are affecting financial efficiency of acquisition model. So I will be placing the links to the whole to the all videos how I created this financial model from scratch in the description of this video. And also at the end screen I will be placing the link to the playlist where all these videos will be kept. So you can watch these videos from scratch and build your model. You can add different parameters. So I just give you the scheme that you can use, and I hope you enjoyed all this stuff. You may give us a like, subscribe, share this video with your friends. You can also order financial models from scratch for your unique business ideas. We can help you with that. So see you guys in next videos. Thank you and bye.